Welcome to Global Chief Investment Officer Symposium, a paradigm shift, global investment in a restructuring world, co-hosted by Financial Times FT Chinese and VS Partners, a boutique asset management firm that invests globally and pioneers outsourced chief investment officer model in China. I'm Michael Lin, multimedia editor of FT Chinese, a moderator of today's panel, The Importance of Small Companies in Real Economy and in Capital Markets. In Chinese and Mandarin, we say 中小企业在实体经济和资本市场的重要价值. So small companies may be overshadowed by big names, but they play a crucial role in our daily economic life, contributed about 90% employment, even in economies like China. How do fund managers approach small caps? What opportunities do they see in this segment of this market? So let's find out with the two respectable panelists. With me today, they're Tiffany Hsiao and Craig Stone. Tiffany is managing director and founding portfolio manager of the Artisan China post-venture strategy at Artisan Partners, a global asset management firm with an OM, which is asset under management, for the record, of over $175 billion. She was a AAA rated China equity manager with consistent top performance. Welcome, Tiffany. Craig Stone is a portfolio manager at Kane Anderson Rudnick Investment Management, whose stands at $62 billion. He has approximately 32 years of equity research experience, primarily for the small and mid-capitalization industrial sector. A few portfolios that Craig, who manages, have received the PSN Top Gun Manager of the Decade recognition. Welcome, Craig. So let's start with a discussion with the first topic on the market significance of SMEs. So one thing in common in the structure of US and China is that large cap tech companies dominate the capital markets, but it is SMEs that create majority of the economic growth and jobs in the real economy. It's tough to beat the benchmark if not owning these big tech. So what's your way to outperform? How about Greg, please?
Sure. Thank you, Michael, for having me here. As you noted that in the beginning, small cap businesses are a vital part of the economy here in the U.S. and also in China as well. So it is important whenever we see that economic growth is to happen, the small cap businesses have to be leading that way and participating in doing so. Otherwise, it's not going to be a robust economy. And we've seen that throughout history, and numbers prove that out. One of the things that we do here at Kane Anderson Rudnick is that we believe that earnings growth over long term will drive stock returns. And if you look through history, you'll see that small cap companies have outperformed over long periods of time. And we believe one of the reasons that they do is because they have the ability to deliver faster earnings growth over long periods of time. And one of the simple things is the law of large numbers, right? Because if you have a very large company, and today some of these large cap businesses are in the $1 trillion market caps, and they have hundreds of billions of sales, it's very hard to grow sustainably double digits with that large of a number. It's much easier for smaller businesses with a smaller revenue base to grow sustainably double digits for a longer period of time and sustain that over long periods of time. So we think that by owning small cap businesses and the ability to grow faster over time, that will translate into better stock performance over time. And it just give you a number. I mean, if you look at the top 5 names in S&P 500 today, it's roughly about $9 trillion market cap. And that's 3 times the entire market cap of the Russell 2000, which is the proxy for small cap companies here in the US. I mean, that's astounding how large those just 5 names have become. So we think that there's much better opportunities in small caps to find these companies. And, we do it through a quality lens that I can get into, but simply, through the faster earnings growth and the sustainability of small cap earnings growth, we think that's a better way to be and a better place to be over a long term.
Right. And Tiffany, you're also known as the queen of small cap stocks. So how do you beat the market?
Thank you, Michael, for the kind introduction, and thanks for having me here. I think we adhere to a few simple rules. I think the most successful small cap companies are the ones that start small, but they actually scale up really big over time. And secondly, we really want to focus on companies that can solve big problems, because the bigger the problem that they can deliver solutions to, the bigger their addressable market. So those are really the two key things that we look for and that have worked historically in terms of small cap investing. So to think about that, let's peel the onion a couple of layers down. So to scale, there's two ways, right? One is you may have a very large domestic market that's very helpful. Or secondly, you have a very large export market that you can export to. So if you think about those elements combined, there's only really two economies in the world today that has both elements, right? So both US and Chinese small caps both have a very large domestic market for these small companies to initiate their product research and to really serve the domestic market in their early years. But then also, the problems in these two economies are not unique to US or China. Their solutions can be exported globally over time. And that's what makes a small company become successful and scale well over time. So we see a lot of opportunity, particularly in China small caps that we invest in. And I think the other thing in terms of quality that Craig mentioned, that's really a very important factor when you invest in smaller companies, because they are smaller, they are subject to more different types of risk, regulatory, operating, environmental risk. So you need to find companies that have really stable cash flows, right? Or can really have a good balance sheet to weather at least 2 years and fund their own growth for the next 2 years. So those are really important aspects. So a very liquid and large and supportive equity and also the debt markets are helpful for small cap investing. And that's what you also have in the US and China small cap markets.
Thanks, Tiffany. It's a very interesting time, thanks to the virtual symposium that we don't have to wear masks all along, right? But the pandemic is a stress test on business resilience. In each of your core market, what are the business or sectors that you see sailing out of the pandemic stronger, and what are the ones suffered? Could you share with us your insights, Greg?
Sure. It's funny, Michael. Every recession is different. If you look back, 2001, you had a business recession. 2008 and 2009, you had a credit recession. Now we have the pandemic recession. So the companies that are affected from each recession is a little bit different. We saw in this recession environment where some of the companies that did fairly well and weathered the recession fairly well, and the last two recessions didn't do so well. For example, like a pest control business, right? If you think about the pest control business, typically they are fairly recession resistant because commercial accounts and residents don't want to have pests and bugs in their house or place of business. So that's one of the last things they cut spending on. But because of the mandated shutdown that we saw across commercial restaurants, theaters, hotels, some of the pest control businesses didn't fare as well or had a harder downturn than typically in a normal recession. But on the other hand, we also saw industries like the pool industry, the swimming pool industry here in the US, where historically it's a bit more cyclical. But if you look underneath, you'll see that this industry, about 75% of the industry spend is from maintenance products. So it's less dependent on construction than most people think it is. And the unique thing that happened during this pandemic is that as commercial businesses were shut down, people worked from home more. They actually had to spend more time in their swimming pool with their kids at home. And so pool usage actually went up. And so pool spending for maintenance products actually went up as well. Which is very unique. So we like these kind of businesses where it's kind of misunderstood. It's kind of has a high percentage of, I don't want to say recurrent revenue, but high maintenance and cost kind of material revenue base that kind of can weather through a period like we just saw. And so business like that, where, like I said, 75% of industry spend, we love kind of those businesses, and those businesses have done well for us coming out of the during the recession and into the recession and out of the recession.
And what's your perceptions on this factor, Tiffany?
Yeah, so I actually agree with Craig a lot. A lot of small businesses or small cap stocks, actually, whether US or China, they're small simply because they're misunderstood, right? They're under-researched, under-allocated to. So they're very fast growers, but the valuation is very cheap. They're just waiting for more investors to discover the benefits of small caps. So absolutely agree with a lot of the alpha is to really do your homework. And in terms of the area, one way to do your homework is to really be close to the industry. As I mentioned, we try to focus on small companies that can solve big problems. So we always have to understand what the problems are. And what we see in China in this pandemic is that there's really a few areas that was really troublesome for the Chinese government. Number one, obviously, because of COVID, there's a lot of disruption, particularly when it comes to logistics, that's driving up inflationary pressures across the entire value chain. The second problem is that, China actually has an aging population over time. So a lot of structural issues need to be dealt with when you have an aging population. Everything from increasing worker productivity to trying to find more effective and cost-effective ways to manage healthcare bills because of the single-payer system, to having technology independence within China. So as borders seal up, you've got to make sure you're self-sufficient. Where do you get your energy? China is now, taking a step towards alternative sources of energy. Where do you get your semiconductors? China now needs to make its own semiconductors, so on and so forth. So those are areas where we see the industries and the participants fare better because these are the problems in the market and these companies are providing the solutions.
Good for those examples. And but both of you are CIOs. How would you evaluate the health conditions? Further to this question of the health conditions of the small and mid-sized companies in the recovery after the COVID-19. Shall we start from Tiffany?
Sure. And that's why I stress that throughout the entire market cycle, whether we're in economic recovery or we're heading into a temporary stagflationary environment, it's really, really important to find companies that can self-fund. And that's why it's critical for us to find companies that have at least 2 years of cash on hand and to validate that both there's three things that we validate when we look at a company. It's the people, the process, and the product. We want to make sure that all these three aspects of the business can really withstand different economic cycles and different shocks. So we really built in a lot of black swan events in our analysis, in our bearish case target prices, just to see how the companies fare. And in our analysis, we always factor in the possibility that companies completely lose their facilities, either through a natural disaster or that people cannot go to work. It may be man-made or nature-made disasters that prevent people from getting to work. So those are all the things that we have to consider when it comes to risk managing small businesses and assessing the downside, in addition to realizing the upside of these businesses.
All right. And in light of the worldwide inflationary fears, rate hikes and possible market jitters by some implication of supply chain crisis, how do you manage, to protect returns by investing in small and mid-sized companies that might be more vulnerable to cost inflation, labor shortage, market liquidity flows, etc.?
Yeah, I think, Michael, one of the important things that we try to focus on is that in an inflationary environment like this, it's going to hit all companies. But what's important is to find companies and own companies that have pricing power, the ability to pass through these inflationary costs. And more importantly, not just be able to pass it through, but be able to keep that at the end of the cycle. So you can tell, a lot of these companies, the commodity type companies, can pass through these costs currently. But if the cost inflation subsides, or at the end of the cycle, the cost actually comes back down, if you have a non-proprietary product and you're sort of selling a commoditized good, a lot of times these companies have to give back the pricing that they've taken. We want to find companies, we want to own companies that have the pricing power, but not only to be able to protect their margins on the way up during inflationary times, but have those kind of competitive advantage or distinct products that allows them to keep those pricing when commodity prices are coming down or subsiding. And that's important to us. It's not just about protecting on the way up, but also be able to keep those margins or the pricing on the way down. I think that the one thing that I think a lot of investors are worried about, there's two folds. One is interest rate, and the other is cost inflation, right? I think we tell everyone to keep in mind that inflation, the interest rates are probably going to move up higher, but if you measure to historics, we're nowhere near where we were even back in 2018, 2017. I mean, we're still sub 2 on the 10-year. And so maybe we'll get to 2.5, maybe. I mean, if you asked us 5 years ago where interest rates going to go, and we would have said we would have been past 2, 3 by now. So who knows, right? The Fed is trying to do a very delicate balance on what's going on. On the inflation side, the other thing that's the worrisome that the investors have, the material cost is more worrisome to us because that's a direct markup. Steel costs moving up 2 to 3 times. It hits consumers' pocketbooks, right? But actually on labor, we're less worried about that because actually that's good because it increases consumer spending power. Now, it's being offset by the high inflation for products because of the material costs. But if it's just labor cost by itself, it actually does spur GDP growth. So, but we're having both right now. So if we have to have one, we'll take labor over the other one, right? But you don't want labor costs to go completely out of control and expand too quickly. But we haven't had labor wage growth here in the U.S. for a very long time. So some of that is good to have. Small caps, we believe, like Tiffany said, here in the U.S., on a relative basis is cheaper than large cap. If you look at, again, if I go back to my numbers of the 5 largest companies in S&P 500, not only are they really big in market cap, they're trading something like 8 times sales. And the average small cap is like 3 times sales. So you can see clearly the infinity for all these large caps and the money flow that's gone to them. I think investors are going to realize that small caps can do well, but they need a growing economy. And I think as long as we don't get a double dip or any more pandemic induced shutdowns and news like that, I think the economy is going to do better. And so therefore small caps will do better. And then with the relative valuation advantage that they have, they should do well.
Mm. And Tiffany, what's your golden rule in this returns?
In inflationary times, I agree with Craig. One aspect is to pay attention to companies that have pricing power. But what we're increasingly seeing is that, in shortages, inflation is usually because there's a shortage in the market. During times of shortages, only companies that really execute on their supply chain and on their products can actually get enough parts to build their product. So it's not only whether or not they can have pricing power, but whether or not they can actually deliver solutions. So the aggregate amount of sales during really inflationary times, that's also a key monitor that we pay attention to.
All right. And I think it's a question for Craig in terms of real value investment, because you are well known for this philosophy. As to the value investment and quality investment, how early should we engage with the small companies of potential, some of which are in a stage of market cultivation, but earning multiple based valuation methodology might not be suited for such companies?
Yeah, I think when you engage in these type of companies, I think one of the things we ask ourselves is that, we want companies that have the ability to create products that are better, cheaper, and faster, and offer all 3 of those things. And I think here in the U.S., we are lucky that we have a sort of a vast existence of the venture capital market that has been able to provide a lot of capital to help fund some of these small cap companies. But we also see at the same time, a lot of these small cap companies that are being funded or coming public, have low profitability or have a path to where it's going to take multiple years to have profitability. We're okay with that. We're willing to look at that. But the problem is that at the end of the day, we still want companies that have the ability to generate cash or have the ability to protect the margins and have all that. So the way we think about it is that, yes, we can be a little early, but these business models have to be able to serve a large enough market to have the ability to protect themselves and continue to grow. And for us, these early stage companies, let's take, for example, technology, right? That's where we're seeing a lot of these companies coming public. Some of these multiples of earnings, it's sort of irrelevant to look at. Some investors look at price to revenues and stuff like that. But for us, those are factors. But another important factor for us is the quality of management. At the end of the day, the management teams are the capital allocators, right? They're spending the money. And so for us, it's important to trust them, important to understand how they're going about that. What is their path to profitability? What is their, are they serial acquirers? Are they just trying to become larger cap managers? How critical are their capital allocation decisions? And we focus a lot on that. Another area for us is, here in the US, we're seeing more and more where larger cap companies are doing spinoffs. And so we have an opportunity not just participate in these early venture companies, but also trying to find companies that have been ignored, that's been embedded inside a very large conglomerate structure. But these are sometimes very wonderful crown jewel businesses. And once they're spun off, you'll find that oftentimes that they can become gray flowers that blooms very nicely, because all of a sudden there's attention, there's capital available to them, or just a renewed focus. And a culture is very important, and you want people working the companies who are excited, who are driven. And sometimes just by a spinoff like that unlocks a lot of that potential. And so we focus a lot of times trying to find those undiscovered gems as well from that kind of area.
Thanks, Greg. And to Tiffany, what is your methodology in discovering the giants of tomorrow and generate excess return?
This is how we think about it, right? So we want to invest in companies while they're still small and want to have companies that really scale over time. So let's dissect this into two components. When the companies are still small, there's a different set of risks that you need to look at. A lot of companies are small or recent IPOs in the market. There's not a lot of history with public market investors, and that's why they're ignored by the market. The way we overcome that challenge is we start our due diligence of companies 2 to 3 years before the IPO event. So we start engaging with companies post their Series B of private financing to really get to understand the people behind the business and how they're executing in their track record over time. So by the time the IPO hits, we are quite confident that we know the business and we have a good ability to value and have a good probability of outcome when it comes to projecting the business success rate. Also, the second portion is whether or not these businesses can really scale over time. And as I mentioned earlier, that part really comes down to having people on the ground to have a real-time pulse on what the problems are in the economy. Again, the bigger the problem, the bigger the opportunity set for these companies to grow. And also by having people on the ground, you can monitor the competitive landscape much better. In China, there's a saying that 1 year in China is 10 years in the US because everything happens at a much faster pace. In fact, some people argue there's too much competition. We call it in Chinese 内卷, which is a very severe problem in China. Yes, 内卷. So, you have to be able to monitor these situations in real time. So both when companies are small, there's areas that we really focus on in our due diligence. And once companies get bigger, there's a different set of scenarios that we have to monitor.
All right. Thank you. Small companies investing often risk stepping into landmines. How do you, on one hand, identify companies that are undervalued and on the other hand, risks are weak ones to protect your portfolio from excessive volatility? Let's start from Craig.
You're right, Michael. Small cap company investing seemed to be higher risk. And the way we get around that is that we say to our clients is that invest in quality. So by investing quality companies and businesses, what you see is that these companies underlying have lower business risks. Mm-hmm. They have better balance sheet. They have higher sustainability of earnings. We're able to find in small cap in the quality realm companies that can not only do well when the economy is good, but it can actually protect or do even better when the economy is not doing so well. So by staying in quality, or as we've referred to them, the companies that we own are kind of the next generation of blue chip companies. These are businesses that often investors in large cap land favor blue chip companies, but in small cap, these have all the same characteristics, but just the market cap is smaller. And so technically, I guess they don't qualify as blue chip, but we're looking for these kind of businesses that can do well and have similar characteristics and protect during those volatile times like we see what we have seen. So staying in quality is, I think, one way to avoid that and be able to protect small cap investors from those kind of volatilities.
Mm. And Tiffany, how do you normally deal with the risks?
So let me try to give a little bit of background of Chinese small caps. So in terms of the landmine title, when you look at Chinese small caps, in terms of the overall level of volatility, it is actually not as volatile as in the US, where the Russell 2000 is consistently more volatile than S&P 500, for example. If you look at China, for example, the MSCI China Small and Mid Cap Index, the volatility is actually much lower than the MSCI China. So let me explain that a little bit. A lot of the smaller companies in China, like I said, they're under research, underexplored, especially by foreign investors. So the benefit of that is that you don't get the sentiment flows, which could be quite volatile for foreign investors. The larger companies in China, they do have a lot of foreign investors as participants in their share purchases. So you do have that additional element to contribute to volatility. Now, that said, it's really important still to do bottom-up stock picking in China. There are over 5,000 small and mid caps in China, and you do not want to own all 5,000 of them. Again, the way we look for businesses is twofold. We want businesses that can really scale really big over time. And the way they do that is by solving really large problems for the economy. So we continue to focus on areas that can deliver those type of companies. So right now, the biggest opportunities that we see are within consumer. It's very selective. We want consumer companies that can really help the millennial consumers, which is the largest consumer cohort, better manage their time. They're trading money for time to have better experiences and better conveniences. Within healthcare, again, we're looking for companies that can really lower the cost of funding healthcare in China as the population continues to age. And then finally, on technology independence, we continue to be very favorable towards semiconductor companies, not just for technology, but also for alternative energy, and also software and robotics companies that can really combat the aging workforce. So those are the areas that we, basically try to identify and see more tailwind rather than headwind. And from there to go do bottom-up analysis, stock by stock, company by company, tracking them from pre-IPO all the way up when they're, I like your phrase, Craig. I think I might steal that to the blue chips of tomorrow.
All right. Thank you, Tiffany. Thanks that you mentioned about Russell 2000, for example. Small companies triumphed in the 2020 market, as we know, while the general performance in this year seems average. So what bothered them from beating the market again? Have they lost their momentum? Correct?
I think, we talked about in the beginning that generally small cap businesses do well when the economy is recovering or expanding. And so I think what you saw last year was that when the vaccine announcement became available in November, investors are always forward-looking. And so they were saying to the market or predicting that the economic times was going to be better ahead over the next 6 months, 12 months than what we've seen from the last 6 months during the pandemic. So small cap led the way and rallied very strongly in Q4 and also Q1. And then what we saw here across different regions is that the Delta variant became another variable. And so once that became known, and you had various regions, again, here in the US, we saw certain states like where Tiffany and I are in here in California, we had shutdowns and mandates and new regulations and renewed fear of a reprisal of the pandemic. And so the economy became uncertain. Investors, again, forward-looking, saying to themselves, well, maybe we were too bullish and maybe the economy is not going to recover as fast. And so there was a pause in there. And so small caps kind of languished a bit. So I think it really is a forward-looking look on the investors' expectation of the economic recovery and where that is. And so what we've seen in the last month, again, once now that Delta has become less of a headline, and now where everyone's talking about economic recovery again, small caps are starting to lead the way again. So I think, again, it's one of those things where the economic recovery is going to be key for small caps to outperform. And we saw that late last year, and now we're seeing it again now. But like I said in the beginning, earnings growth is going to drive these companies. And so if the economy is going to recover and do well, small caps should lead the way, because here in the US, and as Tiffany mentioned, in China, small caps are very important, small businesses. And so if the economic recovery is here for certain, and it's here to stay, then small caps should do well once again going forward.
Thanks, Fred. In emerging markets like China, the local authority has acknowledged the importance of small companies actually recently by setting up new exchanges. What makes the difference between the small cap market in the developed world and the developing economies? Can I ask Craig to continue on that?
I'm not sure I'm the expert on China and small caps. I think I'm going to leave the bulk of the comments to Tiffany. But from my layman's view here in the U.S. is that I think, the U.S. in small cap has had a long history of talent, particularly let's take the technology world, or in terms of venture capital or just funding and capital necessary for small company formation. I think we've done a better job here in the U.S. of embracing that and a culture of that. But I think that's changing. I think you're going to start to see other regions. Again, I'm not going to comment. I think Tiffany has a much better view and better sense of what China is like, and so I'll leave that up to her. But I think other regions are starting to catch up, and so I think that's going to be something that's, the developed world hasn't done a good job, but I think the developing world is starting to catch up and are poised to challenge that.
Sure, I'll leave this to Tiffany.
Great. I think let me just answer the question is that, how are small caps in China really different than small caps around the world? Again, I'm not an expert on the rest of the world, but I'll just take my perspective from looking at China and also, in my 20-year career history, having also invested across Europe and the US as well. The really interesting thing, when I first took on the Chinese small cap universe, and I was really surprised by the type of companies that I found. The historical impressions of small caps in China are that they might just be really niche companies, or they're just tiny little exporters of toys and shoes. But again, when you look deeper under the hood, they're really great companies. And I think that has to do with the DNA of China and why over time such great companies emerge. Well, number one is that, as you all know, China is still a state-run economy, and a lot of the allocations, whether it's capital or even human capital, are allocated by the state. So in that environment, of course, the most entrepreneurial and the best problem solvers are going to be in the private sector, and thus the smaller companies tend to, again, be more exciting places to work, and that's why they retain the best talent to solve big problems. So that is one structural element. The other structural element, again, it's a misconception that emerging market small caps must be very heavily debt ridden and they cannot survive any down cycle in the economy. That's actually not true. Again, looking at China more specifically, in the old days, only state-owned enterprises could get a bank loan. Right? So if you're a small business, an entrepreneur with a great idea, you better figure out how to self-fund your business as you grow, because you cannot depend on the banks. And until very recently, there were no VCs and the equity market was relatively small. So these businesses have that that resilience in their DNA to really make sure that they build a very sound business model to meet the challenges that they're trying to provide solutions to. So I think those two elements make the Chinese, entrepreneur really interesting of a cohort to even begin your search. That said, I think, on top of which, in the more recent days, you do see more, private equity, VC participation. You do see, as you mentioned, the Beijing Stock Exchange now open up to small businesses. Every time a small business gets to take in a lot more money, that's really when you need to be careful and really, really monitor your risk. And as I mentioned earlier, we have a very long checklist of things that we need to see before you invest in a company. And a lot of that has to do, again, with asset allocation, right? So where are they spending their capital, how they're retaining their talent, and do they have the right product, or are they simply trying to create lots of product to show market cap, right? So all these things have to be considered in a holistic way. But I would say, all in all, the Chinese smaller companies is a really good hunting ground for great companies, great entrepreneurs that have great solutions. But even as the liquidity improves in the market, that's when active bottom-up stock selection is actually even more important. So we believe that longer term, that's really where you generate long-term returns, and not just by betting on increasing flow into smaller companies in China, which is happening now.
How do you perceive the timing investment in Chinese small tech companies now, Tiffany?
So the Chinese government really helped us, buy growth companies at a discount this year. But, the way we think about it and the way I think about timing is that you have to figure out whether or not these are long-term structural issues for your investment thesis. And from our standpoint, the crackdown on big tech, very good for small companies, because finally you can actually hire good engineers without competing with the likes of Alibaba, right? So it's structurally beneficial to smaller companies. On the other hand, the decarbonization strategy, yes, there are ways to refine the strategy. And we think 2022, you won't see as big as a gap in the power shortage, which is really transitory. So that part of the equation will go back to normal. It's not long lasting. So combining the long lasting positive effect of, smaller business now being able to recruit more effectively against large companies, and the temporary stagflationary concerns caused by deflation, caused by decarbonization, I think that adds up to a very good timing for 2022. So we're actually quite optimistic about the outlook, especially, on a quarterly basis, things should really improve.
I read a piece of short news yesterday, actually. It seems you said you were ready for Beijing stock exchanges. Could you elaborate that part of moves and preparations from your side? And, can we invest in it as in the NASDAQ equivalent?
Yeah, so the Beijing Stock Exchange, part of the reform is really to allow the companies that are previously on the OTC board to the qualified companies on the OTC board to have a direct transfer of their shares onto the Beijing Stock Exchange. And as you know, the stocks on China's OTC board, they are really, really undervalued because they're very difficult to trade. But once they are able to make that transfer onto the Beijing Stock Exchange, which starts in 12 days, and we're really excited about it. They can be traded by anyone, local investors or QFI holders like ourselves. So it really improves the liquidity of these businesses. And I think that does two things. One is it re-rates the company because finally people can trade and give it a fair value. The second thing that's important to the fundamentals of these businesses is that they now have a new channel for, maybe issuing secondary to get more capital to grow their businesses. So either way, both from a valuation of smaller companies and also the fundamental business operation of smaller businesses, the Beijing Stock Exchange is actually very welcomed by our strategy.
Thanks, Tiffany, for the insights. And due to time limits, I only have one question for each of you. So that's advices on investing in small and mid-sized companies. Let's start from Craig. What advices would you give?
I think small cap investing should be part of everyone's asset allocation, because I think history has proven that small cap investing can be very rewarding. It outperforms over very long periods of time. We're biased, obviously, because we're quality investors, and so I would hope that investors would, look at quality small cap investments. But I think small cap should be part of everyone's asset allocation because it's an important part of asset class, and it's a rewarding asset class.
Thanks, Greg. And Tiffany?
Yeah, I would agree with that. If you look at the earnings growth of smaller companies compared to large cap companies from 2019 to forecasted through next year, the compound growth rates of small and medium businesses are 31% compared to just 6% for MSCI China. So there's a really big delta there in terms of the growth. At the same time, valuations of smaller companies in China only 13 times price to earnings compared to over 16 times for large cap. And volatility levels also lower for small and medium cap businesses in China. So, if you combine all those aspects together, you get a much better Sharpe ratio and information ratio by allocating to Chinese small caps. Both asset classes should be in your portfolio because they're only 20% correlated over the long run. So there's a room for diversification and to really adding that growth booster to your portfolio.
Thanks, Tiffany. Opportunities lies ahead. So thanks, Craig and Tiffany, for your insightful views on this significant segment of this market. And our readers can check for more updated market news information every day on ftchinese.com. Thank you all.
Thank you, Michael.
Thank you, Michael.